Thank you. Hello. It's very nice to be back in Istanbul again. Sadly, I seem to have brought the rain this time from London. I assumed that it was only ever sunny in Turkey. So you've let me down, I'm afraid. I was asked to talk on this subject, marketing accountability, strategic brand valuation as a tool to determine marketing budgets, which is a bit of a mouthful, really. I think in the end, when it comes to most commercial things, when we are talking about strategic, what we're really talking about is how can we actually end up making more money? And in the end, it is about making profits and increasing shareholder value that this whole presentation is about. First of all, I'd like to show you a chart which comes from a study that Brand Finance does every year, where we accumulate the value of all companies on all stock markets worldwide. We then look to their balance sheets and we add up the value of the tangible assets in their balance sheets, and that's the grey piece at the bottom there, the dark grey piece. We look at their balance sheets and look at assets that have been acquired in acquisitions, intangible assets that have been acquired in acquisitions. So under the accounting rules now, when you make an acquisition, you don't just put in goodwill. You are expected to identify the individual intangible assets that you have acquired, whether they are trademarks or brands, or whether they are patents, or whether they are copyrights. And the light grey piece is the aggregate value of those assets which have been acquired and put into balance sheets under the International Financial Reporting Standard 3, which has been here since about 2004. The red piece is the difference arising in acquisitions, which is known as goodwill. Some people might say that that's actually quite a large proportion, the red, compared with the specific intangibles. And that's largely, I think, because many acquisitions have happened at an overvalue. And when you actually decompose them, you find that the real assets acquired are not as much as maybe the price of the acquisition said. However, we'll move on from that once. You can see there that the balance sheets of all the companies in the world have tangible assets, acquired intangibles, and acquired goodwill. And the green piece is the extra value that the stock markets attribute to those companies over and above what's in their balance sheet. Now, the thing you'll see here is that the aggregate value of all companies marched ahead from a dip at the beginning of 2002 to a high in 2007, and then dropped off a cliff when the current recession began. It recovered, and this, I haven't got the current results on this slide, but it actually dropped again during 2011 as we went into the second phase of the recession in America and Europe. So it's what you might call a roller coaster of value. Expressing that in percentage terms, you can see that throughout most of the 2000 period, the amount of value represented by intangible assets in balance sheets worldwide was approximately 60 to 65%. First of all, that demonstrates the importance of brands and other intangibles, and why marketing people need to focus on trying to maximize that value. It's dropped back, but even now it's somewhere in the order of 40% and is rising back towards the higher number. Now, what this shows is that, generally speaking, markets don't fully understand the companies, they don't understand their prospects, and they don't understand the assets that they operate. And you see frequently, anecdotally, where individual companies are taken over, that they were misvalued by the markets and are taken over cheaply because the markets did not understand what the assets were that they owned. For example, when Cadbury's was taken over by Kraft a couple of years ago, I think the general consensus in Britain was that Kraft got a bargain because the Cadbury share price was very low as a result of the recession and a lack of understanding amongst financial investors as to what they really owned. And they regretted the fact, I believe, that they had not done more to let the markets know what their brand portfolio was worth, because if they had, they might be independent today. So the point is that investors generally are hungry for information to understand what are the true values of the things that they are trading on these stock markets. And this is a definition of investor relations from the American National Investor Relations Institute, where they say that investor relations is a strategic corporate marketing activity combining the disciplines of finance and communication, which provides present and potential investors with an accurate portrayal of a company's performance and prospects. When conducted effectively, investor relations can have a positive effect on a company's total value relative to that of the overall market and a company's cost of capital. My view is that that is absolutely correct, that properly conducted investor relations and explanation of what's owned does make a difference. It doesn't necessarily prevent a share price going down if the market is going down. The important word here is relative. So relative to the changes in the market, if you are communicating well and explaining what you own, you will do better and avoid those kind of Cadbury situations. Now, the two things I've highlighted here are strategic corporate marketing activity, because I think most marketing people do not believe that it is their role to be involved in this kind of thing. They believe it is their role to be an internal function helping to optimize operational things that John was talking about in the last session. I don't think they look strategically enough at what they are doing. Now, in London, we work with a number of marketing directors who actually are habitually taken along to investor relations presentations. There's one guy called Martin Glenn who used to work at Pepsi, very dynamic character, and as a result of being extremely good with the city and investors, he was actually made CEO of Igloo, which is Igloo Birdseye, which is a frozen foods company. It's now a multi-billion company. He regularly goes to the city to persuade them to give him money to make accretive acquisitions, and he is a marketing guy. Secondly, I highlighted the term accurate portrayal. Where it comes to any of this, I think the word accurate is slightly spurious. Sometimes people think that profit and loss accounts and valuation results are absolutely accurate and scientific. For me, the best word to use is persuasive or reasonable. Because what you're trying to do is to demonstrate to a potential investor what a thing is worth. And a lot of that is about perceptions. And a lot of it is about future perceptions. So we're dealing with future perceptions where it comes to the valuation of companies. Inevitably, that has to be a preserve for marketing people, in my opinion. Now, I've put up here a slide from an academic in the States called Bob Eccles. And he has been running a campaign to talk about a reporting revolution to try and get across the information that I am talking about to investors so they can make more informed decisions. You'll see here that he's saying the pinnacle of his temple of reporting is public trust and investor confidence. You've got to believe in the stuff that's being given to you. And his view is that there are three pillars of that. One is people of integrity. Two is a culture of accountability. And three is a spirit of transparency, which I think most sane people would say, surely that is self-evident. Unfortunately, with a lot of this, it is not, and certainly in the last 5 years has been demonstrated not to be self-evident in many, many large companies. And he had a number of plinths that he said this should be built on. One was principles-based global accounting standards, which to most people is deeply boring. But the reality is we now have a body of global. You'll notice here, by the way, that the date of this book was 2002. And I specifically dragged it out because he was talking about this in the wake of the scandals at the beginning of 2000s. So, for example, Enron, Merrill Lynch, WorldCom, a variety of major scandals where investors were cheated and lied to. And so this was supposed to be a whole new dawn of the way we communicated with people to give them fair and accurate information. And I brought it in because I find it slightly ironic that here we are 10 years later, more or less asking for the same things, because largely speaking, it has been ignored. The one thing which has definitely been introduced is global accounting standards. He then said that you needed additional industry-based performance information so that people could understand for themselves what was going on. Thirdly, improved external reporting beyond the requirements. Many companies do not give away anything more than they have to, and there are valid reasons for that, like giving information to the competition, but it makes it very difficult for sensible investors to form a view as to whether or not these companies are worth what they say they're worth. Thirdly, enhanced performance reporting and analysis using the internet. Fifthly, having true and fair accounts from auditors, which again you would say is self-evident. At the time he wrote this, it was not. And he pointed out the fact that most audit firms received more money in other fees than they received in their audit fees. And there were numerous instances where they were actually bending the results that were going out to the investors for self-interested reasons. And it was as a result of that that they all divested their management consultancy divisions, well, with the exception of Deloitte, who decided to hang on to theirs, but the other three divested them. Interestingly, over the last 10 years during the boom, they've all regrown them again. So they're actually back to square one again, in my opinion. And they say they are not, but I'm not sure that's true. And the final one is to strengthen corporate reporting supply chain links, which sounds like gobbledygook to me, but basically it is just giving more information in a more digestible form so that people can understand what these things are worth. So there you go. His temple of Mammon, or temple of good reporting that will help people. And I thought it was great when I read it 10 years ago, and I think it's great now. Sadly, it hasn't necessarily come true. Now, the framework that he laid out, which, again, is just as relevant today as it was then, is this. First of all, it all starts with transparency. You've got to have a philosophy of transparency and willingness to share. I frequently go into companies where you talk to the finance director and you say, "Can I see your P&L?" And he says, "No, we don't show that sort of thing to marketing people." And then you talk to the marketing guy and you say, "Do you have any idea what profit your brand makes?" And they go, "No, they won't show us the numbers." And regularly that happens, all sorts of reasons. In the same way that there is secrecy about divulging information to external markets, there seems to be a culture of secrecy in many companies about even telling their own people what's going on. So is it any surprise that you suddenly discover that people are chasing sales even if they're loss-making, and actually they're destroying value, not creating value? It's an insult to the intelligence of marketing people and demonstrates a fundamental problem in many companies that they won't be transparent. It happened the other day, actually, with a major company where they basically said to us, "If you want to do this brand valuation, David, I suggest you go to the equity analysts in the city and get the financial figures that they've got, because they're more or less right, and use them to tell us what we should do, rather than getting our internal ones." So transparency is crucial. Secondly, identifying the key financial and non-financial value drivers and relationships between them. Looking at any business and trying to say what a brand does to it or what marketing does to it is utterly pointless if you do not understand the fundamental drivers of how that business works. And I'll come back to that later on. You must understand how the business works. Thirdly, developing necessary measurement technologies and IT systems, which again sounds like a statement of the obvious. 10 years on, I still don't think we're anywhere near there. People are always talking about how they're going to create a reporting and scorecard system, blah, 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 and they quite often get us involved, and very often these projects turn into a joke for the same reasons that I mentioned about divulging information. You get in there and you discover there is a silo mentality where it's almost impossible to get people to cooperate with each other and provide information. Next is transparent internally to facilitate value-creating decisions. That's a very polite way of saying what I just said a moment ago. How can you possibly make a value-increasing decision if you don't really understand the structure of the business and the financials that go behind it? Linking compensation to that. Once again, over the last 10 years, if this theory had been applied, we might not be in the crisis we are currently in, particularly in banks. There has been a weird culture of remuneration in banks where all you have to do is get the transactions in through the door. It doesn't matter what the health of the business is. It doesn't matter whether there's a long-term return on those things. You're probably only there for 18 months before you move to the next bank. And bonuses, certainly in the UK and mainland Europe and America, totally disconnected with the long-term value-creating ability of them. And finally, distributing all that information in a variety of multimedia forms. Now, disappointingly, I don't think most of that has really happened. I think some people have tried, but I don't think as a whole it is happening. Finally, what he said was that in the ideal world, the management would disclose market overview information about the competitive environment, the regulatory environment, the macroeconomic environment, and then within that, they would say what the internal information was about the value strategy. What are they trying to do? How are they trying to, what are the goals and objectives? What's the design of the organization? How is it managed? Then on managing for value, looking at economic performance, financial risk, and particularly segmental performance. And then finally over there, going to the next level of detail to describe what are we doing on innovation, what are we doing on brands and how strong are they, customers, supply chains, et cetera, et cetera. Now that would be great. But he warned at the time that one of the key issues would be consistency and integrity of data and trend data. I would wholly endorse what he said. Because once again, you very often go into companies and discover that the way that they are measuring things chops and changes from year to year. And finally, the independence of the reporting entity. Who is actually making sure that this information is not bent, basically? Now, once again, I suppose I've probably been in this industry too long, really. You see too many things. But frequently, you are asked to do brand valuations because someone thinks they're doing well. And basically, they want a valuation or an analysis, and they might even put it in their annual report, either because they're looking for a job, or they're looking for a big bonus, or a pay rise, or something, or a promotion. They don't really want long-term reporting of this information, because what if it goes backwards? Things go down as well as up. And so I often think it's very selective. People want to put this measurement in when they think things are going well. They don't want to put it in there for long-term management to make sure the decisions continue to be made sensibly. So there's my cynicism, probably coming from the fact that I'm in the UK, where we are surrounded by cynicism. There's been a total collapse in trust in organizations. I don't know whether you may or may not be familiar with this company called Barclays. Barclays is one of the biggest banks in the UK, and this was going all around the internet. The interesting thing, I think, if we look 10 years on from Bob Eccles' recipe for improved performance, was that in those days, it was quite easy for companies to hide things. Most communications was outbound in the form of advertising. Nowadays, it is absolutely stirred up and accentuated by one-to-one communication via the internet. You cannot escape the internet anymore. But, looking at it in reverse, it actually creates a huge opportunity for challenger brands, which Turkey has got many of, with brands that don't have huge resources but do have the required integrity. And it's not just corporate brands that have a problem. If you actually look at just about every sector. We had the Olympics in London this year. It was quite amusing. There was an article in the marketing press, I don't know whether anybody read it, from a fire brand, I think is the polite way of describing him, called Mark Ritson, who is now at the University of New South Wales, Melbourne University, who is a business school professor down there, who I think he's an academic that doesn't waste his time on research. He just likes mouthing off in the press. He writes endless, ridiculous articles where he takes very strong positions. And one of the positions he took was that no one would be a sponsor of the Olympics unless they were a crook. Because only crooks have the incentive and the profits and the desire to actually sponsor the Olympics. So he reeled out BP, you know, because they ruined the Gulf, Dow, because they poisoned everyone in India, McDonald's, because they make everybody fat, Visa, because, you know, they want to rip you off, etc., etc. Now, he's a bit of an idiot, frankly, in the stuff he says. He does it for extreme to try and create an argument. But the reality is, this sort of stuff is whizzing around the internet the whole time. So you have to be extremely careful. So I think in most organizations, certainly in the Americas and Europe, there needs to be a serious culture change. The belief that you can do things behind closed doors and keep it all secret has gone away. You can't. If somebody outside doesn't notice what's going on and put it around the internet, somebody inside will leak the information. So I think there is much, much greater scrutiny on companies to do the right thing. And in a nutshell, I suppose you would put those four together. You've got to get your business strategy right and say how you're going to make money. You then put your marketing and brand strategy to match that. And frankly, you have to bring marketing and brand people into the discussion about business strategy. We did a rather amusing project for Shell about 6 or 7 years ago, which they called Project Qi, which means energy in Chinese. And we were asked to participate with the whole brand and marketing team to develop the ongoing forward strategy for Shell. And the first question that somebody asked, well, one of the consultants actually asked, was, so what's the business strategy that we are going to do this brand strategy on? And they said, well, we don't know. They haven't told us. And nobody knew whether their intention was to get out of retail downstream, whether it was to go into nuclear, whether they wanted to go for renewables. Nobody had a clue what their business strategy was. And yet we were supposed to sit in a room and talk about what the brand strategy for Shell would be. I think they kind of realized how stupid that was, and they suspended the thing until they were prepared to actually divulge what the business strategy was. Anyway, so the behavior, the culture within the organization then needs to be consistent with that, and then it needs to be communicated consistently to stakeholders. Okay, I'm putting him up because he's one of our clients, and he's a pretty good bloke, I think. He's done a few things wrong in the past, but I think you wouldn't find someone who was a multi-billionaire who hadn't done a few things wrong, like, for example, not always paying his tax. However, generally speaking, I think he is actually admirable. And he does what he says he's going to do. He says he breaks his empire up into small pieces, and there are now something like 400 companies trading under the Virgin name, and he breaks them up into pieces specifically because he wants them to be small enough so people understand and feel empowered and are part of what's going on. He says big organizations just get completely out of control and nobody knows what's going on and they're riven with politics. Now, maybe that's a rationalization of the fact that most of his businesses are small, but actually some of them are now quite big. Virgin Atlantic is seriously challenging British Airways. And in the old days, it was one plane against the dark empire. Now he is virtually their equal. And what he says is, Virgin has a promise based on 5 factors: value for money, quality, reliability, innovation, and fun. That's what they do. And he says, at Virgin, we know that the brand name means, and when we put our brand name on something, we're making a promise. It's a promise we've always kept and always will. Harder work keeping promises than making them, but there's no secret formula. And Virgin sticks to its principles and keeps its promises. Now, obviously he'd say that because he runs the company. I think there are instances where they've deviated slightly from their principles, but I think broadly speaking, it's true. And they have a very flat structure, and everyone can talk to this guy. You know, you walk into their office in West London, he lives around the corner, and he's always in, you know. Sometimes you might not even realize it's him. You think some tramps walked in off the street. But he genuinely believes it, and he pushes it forward. And if you don't, you can't get the organization working effectively. So all companies should have a Richard Branson, basically. And when you have one, the company can make a promise to the customer and enable the staff, and the staff then deliver the promise. It's sort of not rocket science, really, is it? how many companies do you go into where the bloke in charge has not communicated the strategy, won't divulge the information, and is it then any surprise that you see the people sitting around at the desk going, well, I don't know what's going on and I don't really care? Because in the end, the brand via the people are there to communicate with all these audiences, and that is how brands create value. So now I'll move on to the boring bit, the valuation piece. I think there is a huge, before I move on, there is a huge opportunity, in my opinion, for Turkey. And I've had various conversations in the past, and I've been having them today and yesterday. Turkey is brilliant at making things, you know, original products, agricultural products, manufactured products, all manner of different things. Turkey is brilliant at it. It has very strong brands that are strong in Turkey, because Turkey, I think, likes using its own brands, and there's a homegrown thing about Turkey. There are not, it's quite notable coming to Turkey, there are not that many foreign brands in desperate, clarity here. You don't see the same dominance of the Nikes and the Starbucks and the Cokes and so on as you do elsewhere. I mean, they're obviously here, but you don't see it as much. There are far more local brands. The real challenge for Turkey is it hasn't really had enough brands going outbound. And I think it ought to be able to, because brands grow from their fundamental ability to do things well, and it's then expressing it and communicating it in an appealing way to other audiences. Turkey should be generating a lot more brands on the global stage than it is, in my view. Anyway, so if you believe that brands affect each of the different stakeholder groups, and you look carefully to see if you favorably affect people, it's going to have an effect on their behavior. It's just common sense. The real question is, can we reliably measure it and demonstrate what effect it will have on the business model? And that's our challenge. Our challenge as valuers and consultants is to demonstrate that if you have captivated these people with brand equity, that they will do things that are beneficial to your business model. So you do get higher volume sales, you do get higher prices from customers, you get more reliable, harder working, more motivated staff, you get suppliers that want to do business with you, and you get financiers who feel that there is merit in giving you money at a discount, all of which then adds value. Now, here's me, I'm quoting myself now. I thought I would just tell you what my view is about brand equity. Brand equity, for me, it's a measure of brand preference and the willingness of individuals to express that preference by making economic decisions that are favorable to the organization. It's as simple as that. Some of them will buy the brand, some of them will distribute the brand, some of them will work for the brand, some of them will lend or invest in the brand. They are all behavioral responses to the fact that they prefer you. Full stop. That is why Virgin is so successful. At a personality level, people just prefer Virgin. It's like one of their friends. And the discussion earlier on about the Ansoff matrix, well, Virgin it seems to be an unbelievable brand that can expand into other foreign markets and into other categories with new products. And it does have failures, but it's very good at actually closing down the failures or minimizing the damage with the failures. But it's been successful in a remarkable number of businesses. And that's because it has such strong brand values. Now, the way you do all that, in my opinion, is there are lots of different measurement techniques, but one of the most important ones is understanding what are the attributes that make people go into a category. I'm in the bank category. Why? Because I want my money to be in the bank, earning a decent rate of return, with a branch that's available, with people that smile at me. I get this, that, and the other. So functionally, it has the attributes I want. Secondly, I want it to say something about me. So it has an emotional benefit. Now, recently, Virgin went heavy into banking in the UK. They are winning market shares so fast, they can't even cope with setting up the accounts. They virtually had to shut down their marketing because they were swamped by the number of people that wanted to open accounts with a Virgin bank account. At the snob end of the market, there's another brand called Coutts, which is the Queen's Bank. That says a wholly different thing. There, it's, you walk around with your checkbook, so everyone knows that you bank with the same bank as the Queen. And there are certain types of people who get off on that. They don't mind paying a lot of money because they want to say that they bank with the same bank as the Queen, whereas most people would be quite happy with the friendly service from Virgin. So there are emotional benefits, but the emotional benefits don't work unless you have the functional benefits working first. And then thirdly, what we call conduct attributes, which are you ethical, environmental, etc. Now, that last one would have been almost irrelevant 20 years ago. Now it's really quite an important thing and growing in many categories. And what you have to do with any category is look at what the attributes are that motivate customers to go to that category, measure it, and then work out which brands are doing well or badly on the key attributes that determine brand preference. That is a very big piece of quantitative research that has to be done on a pretty regular basis, and then you have to find ways of statistically analyzing it to demonstrate which are the factors that really drive demand in order that you can put your marketing resources behind the ones that you are not so good at or that you want to excel at, and you put it on the ones that influence the consumers most. Now, I can put a blob like that up on the screen and it looks simple. The reality is this is extremely complex because you have to then segment it by customer types and geographies, product areas. So there's a whole area of analysis that needs to be done to really infer what you need to do to develop demand. But, just simply speaking, what we endeavor to do at Brand Finance is look at the management resources available. How can you affect those attribute perceptions to drive preference, to drive behavior, to drive the financial value? And we usually keep scorecards of it. So if you look at consumers, there are various things you can do. What you might be doing, for example, is making a better product or a cheaper product or a more well-distributed product, or you explain it better, or whatever it might be. Or if you're brilliant at all of that, it could be you're just not communicating the emotional value, so you put more money into advertising. And this is a recipe for making decisions about which attributes are you strong or weak on, and what would it cost you to move the dial on a particular attribute to change brand preference. So the measurement and the valuation process becomes a strategic marketing process. It is not just a measurement process. And it allows you to then predict how can you grow your volume, your number of customers, your prices, and so on. And in the end, if you get that right, and you have shifted people's perceptions, you basically shift the demand curve. At a given price, you will sell more, or at a lower price, at the same price, you will sell the same amount. At a higher price, you'll sell the same amount. And you can apply the same principle with financiers. You can measure what they think is important, and you can do it with each one of the stakeholder groups in order to infer what you do to optimize the behavior of that group towards you. So finally on that, I'll just end with a quote from another famous academic from the London Business School, Tim Ambler, one of our old sparring partners, who is now happily retired but still pops up every now and again. In his view, he was an accountant who went into marketing and then became a lecturer. So I don't think he was ever actually a professor, but he certainly had very interesting views about how marketing worked. And he basically said brand equity is the upstream reservoir of cash flow earned but not yet released to revenue. Now, I think that is a message which many, many CEOs need to be given by their CFOs, because I don't think many CEOs genuinely believe it. So just onto the measurement piece.